Good afternoon and welcome to the first podcast of 2025. I'm Dan Edwards. I'm here with Tucker Maxwell, our co-host. This is the Seattle Real Estate Podcast, and we are coming to you. It is January 2nd, 2025. I got to make sure I say it correctly, and it's good to be back. Tucker, how you doing?
I'm doing well, Dan. Happy New Year.
Happy New Year. Hey, I want to show my new mug. It says coffee is for closers. I got this recently. And then I broke the handle off. So I won't tell you what the handle says because it's inappropriate. But hey, so I thought we'd get back in the mix talking about predictions, thoughts, and stuff about what's going on in 2025, what we can expect with home buyers, what home sellers could all expect heading forward. So we'll just kind of do this discussion style. The first thing I have on my checkbox is, what is the Fed going to be doing with 2025? It seems to be like a lot of people kind of consider that that's like the anchor. Now, I don't necessarily believe that's true, but let's just get it out of the way. As you see it heading forward into 2025, what does the Fed plan on doing or thinking about doing? And what do you think will happen in relation to home buyers and home sellers as a result?
Yep. Yeah. Great question. So, of course, all eyes are on the Fed as always, and they are scheduled to meet later this month, like the week of the 20th. And it's expected that they're going to cut rates. And there's been that expectation over the last 3 to 4 meetings, and they have done just that. They've cut their rate by 0.25%. And we probably should just kind of go back and remind people that the Fed controls the overnight borrowing rate between banks. So kind of the supply of money, that's what they're controlling. They don't necessarily control home loan rates. So with that being said, we do anticipate that the Fed will continue to bring down rates as long as inflation stays under control. If inflation switches course and starts to go back up, which could possibly happen, then you could see the Fed's change course. But right now we're anticipating that later this month, they'll cut by another 0.25%, which therefore is already priced into home loan rates. That's the one thing that people have to remember, is that lenders like Guild Mortgage and large banks, we have to get ahead of that. We can't wait until the Fed does something and then react. So as of now, with the expectation for them to cut rates, we've already priced that in, and we've already kind of assumed that is going to happen.
So essentially, when the markets get all out of whack is usually when they don't do something that you're expecting them to do.
Exactly. Yep.
Yeah. So as long as things kind of follow the status quo, it should be good. Now we're going to come back to interest rates. We're just not going to talk about that right now. We'll come back to the interest rates. But what I do want to talk about is, what will the impact of unemployment be? And I want to throw up a slide here as we're looking at unemployment currently as it sits. So this goes back to 1990s, and you can kind of see where we've been. Obviously, 2019, 3.7 was the unemployment rate. And most economists say that when you're at 3 or 4 or under, that's basically full employment. If you want a job, you can have a job. One thing I will note, though, is it's very interesting in today's world that you have a high number of people that have multiple jobs, right?
Mm-hmm.
They actually have 2 jobs. And I've heard of this phenomenon of programmers like moonlighting. So where they work during the day at a 9 to 5, and then they spend time in the evening doing more coding on a freelance basis. So I would actually say that this unemployment rate really is good news, right? It's kind of where it should be. I don't think that we're going to see it go up or down, but I'm curious your take on this as well.
Yeah, it's a really good point. I'm so glad you brought this up. And the flip side of the unemployment rate is the jobs report. And so the JOLTS and things like that. A lot of our eyes are kind of looking at, are jobs being created? We know unemployment, like you said, 3.7. That just means these are people that don't really want to work. They're happy with being on unemployment. And so we're looking at our new jobs being created. And to your point about the multiple jobs, we've actually seen that as a trend in mortgage applications, where we're seeing a lot of borrowers come to us and say, no, I work two positions. And, then it complicates things as to whether or not we can use both of those jobs and the income and how long have they had them. And do these employers know that these people are working 2 jobs? But yeah, it's a good point. So along with the Fed, unemployment and job creation is going to be a big driver of what happens with mortgage rates.
Well, let's talk about that a little bit. Let's drill down in a different direction because, as we know, the current administration is discussing cutting out a lot of government waste. To me, I know the jobs reports, you get government jobs and then you get private sector jobs. So
Right.
there could be a situation where we actually see this unemployment rate rise if they are able to go through with their agenda.
Yep.
How does that impact things?
Yeah, it's a valid point. It's kind of a waiting game for a lot of this. The other thing, I don't want to change courses too much, but it's the debt, the federal debt.
Mhm.
We're going to be watching that as well, and so unemployment, inflation, and then the deficit. Can we control all of these things while also maintaining spending? And so one way to control spending is to cut government jobs. And so to that point, that's a really good way to control the deficit,
Is cutting government jobs.
cutting government jobs.
Oh, so that could be a double win. But
Yep.
what do you think it will do to the employment number? Because obviously, if you cut a bunch of government jobs, they're going to go to the private sector. So that's going to increase unemployment, which could actually stall the economy in a way, right? So there's going to be some kind of games. I wouldn't say gamesmanship, but playing around with how to make those numbers work, right? Um,
Exactly.
I think it'll have an interest. It probably won't be a short-term impact like 2025, but it's certainly something to pay attention. And actually, let me share. I've got a slide here for debt balance. So this is the housing debt and non-housing debt, and I think that you could see going back to 2001, right? Is that 2003? I can't tell what these are. Quarter one, 2003. Yeah, 2000. Here's 2020, and you can see that the personal debt really, really went high. We actually had, I think I have another slide in here that shows, there we go. So this one shows where student loan debt is, where auto loan debt really at an all-time high, and then credit card debt really spiking as well the last couple of years. So these are kind of things that are going to keep consumers away from the housing market, is this high amount of personal debt, right? That's stuff that counts. For our listeners, what does that count against, these debts?
Yeah, their debt to income ratio, their ability to borrow. These monthly payments are factored in, and we are seeing that. It's amazing how many households are at historically low home loan rates, but are
Mhm.
having to do cash out refinances or pull home equity lines of credit or different things like that to consolidate these high interest credit debts, such as credit cards and things like that. So it is definitely something that we're watching as well.
So I heard recently Bernie Sanders is introducing a bill to cap interest rates at 10%, something like that. Have you heard that at all? Would that be a positive effect for DTI?
Yeah, absolutely. Especially with like variable rate HELOCs and things like that, where we're seeing people, come to us and apply for a home loan, but on their investment property, they have a HELOC at 12, 13, 15%. So I'm interested to know, I haven't dug into that too much as to, what rates is he referring to? Is it all rates? Is it,
I think it's
just,
credit card. I think it's
yeah.
credit card that specifically. Yeah.
I like
Yeah.
that. It'd be interesting to see, Visa and MasterCard and their take on that and, their political
Yeah.
action, committee
What they
try to
want to
shut that
have.
down.
Yeah.
But I don't necessarily think that's a negative. We do have to try to help people. Of course, creating better spending habits is probably the better route to go. But if we can't curb debt that way, then yeah, public policy will have to step in and say, okay, we just need to set the ceiling. It's similar to what they're doing on, you know, home loan fees are being scrutinized a lot. They're
Yeah.
making sure that we're not putting in any fluff fees, if you will. Washington State Housing Finance Commission just made a major stance that basically says they want to review all of our fee sheets, and we've actually had to make some adjustments because they don't want these unnecessary fees. So I could see Bernie Sanders and these policies doing the same thing with credit card companies.
Yeah, just try. I guess, and I agree with you. There's finding a middle ground. I think one of the reasons why these credit card rates are so high is they give them out pretty easily, so
Yeah.
they're risk there. And then on the other side, there's also fraud. So a lot of people, impersonating people. What is that called? What's that called when you have I guess fraud and you apply for a credit card and then they use them and then they're gone. So identity theft. That's what I was
Yeah,
saying.
identity theft. In home purchases, we call it straw buyers, things like that, where
Yeah.
they're stepping in saying they're buying it on behalf of somebody else. And
Yeah. All
yeah,
right.
what's super interesting is if you look at this, disposable income or savings during COVID was outstanding. You had
Right.
everybody was flush with cash, but already, we're January 2nd of 2025, and now we're at all-time historical high debt after not too long ago being at historical high savings across the country.
Yeah. It was one of those things that there was a bunch of money pushed into the economy, and then people took that and just set it aside, which was pretty smart because we didn't know what was going to happen. Right.
Yep,
So
exactly.
now you find yourself in a situation where I believe because of inflation, and then that actually is something we can actually look at here with this chart. Let me go to inflation. Is with inflation up here in August of 2022, it became more expensive. Everything became more expensive. And I think that there's this lag measure, meaning that people didn't really notice this money was leaving their bank account at the speed it was leaving it until it was in the rearview mirror going, wait a minute, did I just go to McDonald's and pay $20 for a Big Mac, fries, and a Coke?
Yep.
I didn't do that, just to be clear. Maybe I did. Okay, I'm not going to lie. I'm sure.
Maybe in 2020.
What's that?
Maybe in 2020, 2021, 2022.
Yeah, 2020.
Not
Yeah.
Dan Edwards of 2023 or 2024.
No, that was Fat Dan. Yep, exactly. So we're now leaner and meaner, and actually saving way more money by planning my food. So there's that. So yeah, go back and look at the podcast tapes. You'll see that. But that inflation right now. So we see our current core inflation is right around 3.5%. Do we see this going down further? Like it says, the goal here is 2. So we've got some work to do. What do you see in 2025 for inflation?
I think all eyes are going to be on tariffs.
Interesting.
If we tariff the number 1, 2, and 3 importers into our country, China, Mexico, Canada, they're the 3 largest importers of goods into the United States. If we tariff those products, if we put fees on them, those prices are going to go up. So it either U.S. based products are going to take over, which is, I think, the goal. But if they don't, and these products continue making their way into the market, and we just charge a higher price, that's going to lead to higher inflation. So I think some eyes are going to have to be on that in terms of, what are the impacts of these tariffs? Do they actually come to fruition? How severe are they? And then can the U.S. domestic producers step up?
And I know that's not a short term, right? Domestic producers probably have been thinking about it ever since the inflation kind of stuff started showing up in 2021, and they were like, "Hey, we need to think about manufacturing here locally." This does actually bring me to a topic that I wanted to throw in here, and that is the impact of AI. And I'm going to say AI and robots. Okay, because this is my podcast and I can talk about robots if I want. However, if you look at like US manufacturing is you're not doing the robot. But actually, like if you look at US manufacturing is we probably cannot compete with the labor that is happening in Taiwan or Vietnam or China or the Philippines or even Mexico without automation. And I think the advent of AI and automation, it may not have the impact now, but I think if we really lean into it, can actually help with these manufacturing jobs. For example, this is actually a very contentious point, is if you remember, I want to say it was October or November, it was probably October, that the longshoremen on the East Coast went on strike.
Yep.
And it was a pretty big deal because you're like, hey, all of this stuff that's coming in from the holiday, that's going to kick inflation. Because if you look back at what happened with inflation in 2022 after the pandemic, is these log jams of boats off the Pacific, off the California coast that couldn't get in because the ports were slow and all that stuff. Well, that's what they believed. But here's the thing is Long Beach automated most of their ports. So the ports in Long Beach are now mostly AI and robots, basically moving containers around. And that's what the longshoremen fought to stop on the East Coast. So I think that as we're talking about this bigger picture of inflation, supply chain, manufacturing, tariffs, all of those things kind of put together, it may not have an impact in the 2025 market, but we should be aware that that would actually help lower the cost of goods and services if we're able to do those things.
Absolutely. And I think, looking at Tesla and Amazon, two
Yeah.
companies that are, huge producers and, contribute to our domestic GDP, they're big proponents of AI and using robots. And if they're, our number one, potentially Tesla is going to become our number one auto manufacturer. Amazon already is the number one, retail, supplier right now. And they both absolutely use AI and robots. I know Amazon and their distribution factories are almost all, they are creating jobs, but a lot of that's done robotically. So it's going to be interesting. It also is going to play into not only inflation, but unemployment, job creation. Where are these people going to go that were package handlers or in distribution centers that are no longer needed? Where are they going to find work? And so will they then maybe be willing to do a job that they're not willing to do today, where we're getting, foreign help with?
Okay. So enough about the robots. Geez, Tucker. Let's talk about interest rates now. So, where do we sit now? Where do we think we're headed?
Yeah. So as of today and right now, mortgagenewsdaily.com, that's, just a kind of our barometer that we'll use for this podcast, is claiming that a 30-year fixed rate mortgage is trading at 7.07% today. So just slightly over 7%. And that's an average. So that means some people are locking in lower than that and some people are locking in higher than that. But we're right about 7. And if you look back 2023 rates, we started the year around 6.1%. We peaked at 7.5%. And then now at the beginning of the year, we're at 7%. So pretty big fluctuation there, 1 to 1.5% change in rates, from beginning to end of the year. I think for 2025, we're not going to see as big of fluctuations. That was not fun for homeowners and home buyers alike. It was a roller coaster and they didn't know what they were getting. They didn't know what their monthly payment was going to be. And so I think the one thing that we can count on for 2025 is that they're just going to be more stable, which may not be the news that most people are hoping for. I think a lot of people may have hoped that I would say rates are going to tank. We're going to see rates drop drastically. It's not really likely to happen. And so I pulled, several different expectations for rates in 2025, just to kind of see what the experts are saying. And they're all right around about the same thing. So the ranges from 5.9% up to 7%. So we're at 7%. So those people were already right. They got it. But Fannie Mae is saying 6.5.
Okay.
The Mortgage Bankers Association is saying 6.4. National Association of Home Builders, 6.12%. National Association of Realtors, 5.9%. Realtor.com, 6.3%. And Wells Fargo, I just wanted to pull from a large bank, 6.4%. So we're all right there within about 0.5%, anywhere from 7 to 6.4%. I think the National Association of Realtors and Home Builders being the lowest, I think that's optimistic. And I love it. They're trying to, probably persuade some buyers to get off the fence.
Well, I'm going to say they can subsidize their rates too.
Absolutely.
Yeah.
Yep. Yeah. We see a lot of that with builders locking in a block of funds with a builder forward commitment. And that's why, your big national builders can advertise a much lower rate than market average. They're paying those points on the front end. And so they're not, the loan is not impacted by those fees. And that's to control inventory. They got to keep moving. They can't have standing inventory. And so they're going to do what they can to incentivize a buyer to buy new construction versus a resale home.
So let's talk about inventory since you brought that up. So essentially here's the story: is worry less about interest rates, more about your home. Finding a home that's going to fit for you, because there is no timing of this market. As we looked at that last chart that showed the monthly, it basically, the monthly mortgage rate, it basically just hovered between these two. There we go, between 6 and 7%. Like for the most part last year, that's what it did. So focus less on that, more on finding a home that's going to be a good fit. All right, now let's go back to inventory. I really do like this chart on inventory. So this is a nationwide perspective. So if you take a look at the inventory highs of 2008, 2009. Now, I show this because it's important to know the context that we are sitting in right now. Is when when we started hitting the peaks in 2018, 2019, we saw our annual inventory, supply of inventory sitting between 4 and 5. But back here in these high, halcyon days prior to the Great Recession, it was 10 months. That's where we hit the big inventory. So we've never hit that, even close to hitting these numbers again that led to the Great Recession, a glut of inventory. And so this is kind of the key, is where you and I have talked about this many times, is we don't find ourselves in a position to advise buyers that there's plenty of inventory for them to take their time. And I'm not saying rush into something. I'm just saying that we are not in a spot where it is a true buyer's market. That's where this balanced line is. And even considering the perception that everything has slowed down, it's just still not enough inventory. Thoughts on that?
Yeah, it's a super valid point, and that's what we're hearing from our buyers. We have pre-approved buyers that have been out shopping for several months, and that's what they're saying. Like, we have our eyes on certain neighborhoods, and there's just nothing new, nothing coming to the market. And so inventory is the big question mark. And I think if you tie that in with home loan rates, it's another reason why we can't really afford to bring in interest rates down too far.
Right.
If the goal is a balanced market, if inventory is an issue, then you have to keep rates up enough to just try to kind of push off a few buyers. And I don't know what the solution is there. We've talked about this, when we were looking at Trump versus Kamala Harris's plans and the red tape around building, and are they going to open up, federal lands to build? Like, what is that going to happen? There has to be movement in terms of how quickly builders can build if we want inventory levels to increase.
And I think moving forward, immigration, meaning moving to the U.S., but also moving around the U.S., it's not going to slow down. There's going to be new households created. That's just going to be the fact. So we really have to get ahead of it. This is the new construction stuff. So take a look at that. Is when you go back to November of 2021, you had this, 110 million in family of new construction. And we're not even close to building at the rate that needs to happen in order to keep up with. I wish this chart actually went back to 2007, because it's even higher in 2007. So it's the new construction. And from what I understand is, as long as the short-term lending rate remains somewhat high, builders are going to be more constrained, because they are more affected by that than mortgage rates are affected by that, right? Because they're borrowing money to build houses and then cashing in money. And not every builder, some builders have their own capital funds and stuff like that. But as a general rule of thumb, if they can't borrow money at a lower rate, then it's going to kind of keep them from building. So that the only other option is to make building cheaper. Building cheaper, which will allow for more building to happen. Not make cheap homes, but just make it more cost effective. So the cost of lumber, the cost of fuel, the cost of workers, I think comes down to having more workers. At 4.4% unemployment, workers get to demand more money. So it's not an easy fix. It's going to be a tough, long way out.
Right. Well, and skilled workers is a big issue. The number of skilled workers retiring is outpacing the new people going into those trades, like 4 to 1. If you look at plumbers and framers and things like that, there's no incentive for young people to go into those fields. They don't feel like that's the path forward. So the labor cost is a big one. And back to that point, builders borrowing at higher short-term rates impacts what they can build. So they're still building, but rather than building 3 spec homes at $350,000, they're building a $1.6-1.4 million home that they can turn a profit on. So if that rate comes down and they can borrow, they can build smaller units at a more affordable cost to really handle the inventory issues. But right now, the way rates are, builders are saying, okay, if I'm going to build, I have to build that luxury home to be able to turn a profit.
Okay, so let's kind of summarize all this. And actually, I'm going to bring one more chart up here to say what this means for buyers and sellers. So number one, this is the total amount of existing home sales. And you can see 2021, 2022, 2023. So what's your prediction for next year as far as total volume of sales? Do you think it's going to be the same or more than last year?
I'm optimistic. I think it's going to be closer to 2022 number.
Okay.
I think we're getting further away from the COVID rates, we'll call them. And so
Yeah.
buyers are just more, in tune with what the rates are going to be. And they're not waiting for something that's not going to necessarily happen. 2023, that number surprised me. I didn't feel like it was that much lower than 2022. I felt like 2022 was a worse year.
Yeah.
But I think it depends on where you're at. And
Well, 2022 was slamming on the brakes. So we were going super fast right until about May. And then it was like, boom, hit the brakes, right? So
exactly.
We had some good momentum built up. But yeah, I agree with that. So buyers, what do they need to do?
I think buyers need to focus on themselves and not worry about rates. So if they can increase down payment, if they can work on their credit scores, that's going to have a far greater impact on their rate than waiting for rates to come down. So if you can get your credit score to 800, if you can go from a 5% down payment to a 10% down payment, those risk factors will probably have a greater impact on the rate than waiting for rates to come down. So I would say just, look internally, what can you do to improve your credit profile so you're a more appealing borrower? That's going to help you get a more affordable home loan rate. And then if it makes sense for you and your family, you find the home, jump on it. Because like you said, there's not a lot of inventory. Get on the train. If you have to, use the equity to then trade up to that forever home, but get on the train somewhere and allow that to start working for you. So even with all these numbers, we still saw home prices go up, even with high interest rates and low inventory, all these things. Home prices are still slowly tricking up. And so the longer you wait, the higher the prices are going to go.
Yeah, that's no doubt. I don't think we're going to see the same level of appreciation, but because interest rates are going to keep some people out. It's going to keep people out and keep the competition tight. I'm actually going to throw out a pretty controversial observation that I think 2025 is going to show up in a way where boomers sell their houses at a higher rate than they did over the last 2 or 3 years. The reason why I say that is we already knew this wave was coming, and COVID really paused it for many of them. And coming back out of that situation, I think it's opportunity for people that are looking to help flip houses can find some deals there. I think there's opportunity to create more inventory, which is going to help that whole inventory number from 4.1 to 5%. I don't see us jumping any more than that. I think it will be, it might be something that changes drastically, but unfortunately, I just don't think we have the type of market that will. I like Seattle for its position in the market. It's not a huge first-time homebuyer market, and first-time homebuyers can find deals, no doubt about that. But I think those people that are moving up or downsizing are going to have a better environment for getting what they want and getting the things that they need done. So, yeah, well, we have this on the record now, so I guess we will find out what the market looks like. Thanks, Tucker, for all your thoughts. Anything else you want to add just to conclude?
No, I think the boomers are definitely, we're going to have eyes on them. We're seeing this ageism thing. I think you and I were talking about that, where, people are getting kind of forced into retirement. And once they get on that fixed income, as property taxes continue to increase, we're going to see them want to control the costs. They're going to be on fixed income. They're going to want to move. So I think we're going to see that for sure. I would jump on your bandwagon there and support that thought. So we'll both go down if we're wrong there. The other thing that I think we just should monitor is the condo market. We've seen a lot of changes with condos. There's still kind of a challenging market, but Florida has to figure out their condo situation. And then I think back to our inventory questions, condos may present an opportunity to, increase inventory.
Okay. Yeah. I know. I have no plans on listing any Seattle area condos because they take a long time to sell right now.
Yeah.
But it is certainly an alternative, a place for some of the folks that are downsizing,
exactly.
maintenance, taken care of. All right, very good. Okay, so you had a great holiday. What are you planning on doing this weekend now that we're in the dead of night or winter here in the Pacific Northwest?
Yep, I'm going snowboarding this weekend. So I haven't been yet this year. I, went to the beach in December, and so now it's ski season. So we're gonna head to the mountains. And
where do you ski?
I was planning on going to Crystal, but after the lift tickets being $200 a day and parking now you have to reserve, and then I heard some rumors about lift lines. I think we're gonna do Snoqualmie because they're gonna open east tomorrow. So it hasn't opened yet this year, and so it should be a good place for powder. But
is it going to stay cold the rest of this today and tomorrow?
Today, through Saturdays, it looks like Sunday it may heat back up and turn to rain. So if you're going to ski, get out Saturday.
I don't have any skis, but it's snowboarding, or not snowboarding. What is it? Walking in the snow, snowshoeing. Yeah. I actually have not decided what I'm doing this weekend, but we'll figure it out.
Awesome.
Okay. Hey, Tucker, thanks for coming on. Appreciate your insights as well. We look forward to a great season. Join us next week. We're going to be here same time. If I had my schedule in front of you, I'd give everybody a great preview. All I know is you're not going to want to miss it. On behalf of the Seattle real estate team, I'm your host, Dan Edwards, with Keller Williams, and this is Tucker Maxwell with Guild Mortgage. Thanks for watching. We'll see you next week.
See you.